quickly get connected with our market expert of the show. Joining me, Sunil Subramaniam, to understand, where the Nifty is headed from here on. Sunil sir, good afternoon. Oil is off the day's high levels, but it still remains above that $100 per barrel. And earlier, Surbhi and I were talking that what kind of a macro impact that would be in terms of India. I mean, if you look at the sell-off, it's across the global markets. But how much of a risk premium has the markets digested as of now? Because Nifty is off by about 10% from its record high levels.
See, I heard Subhi speak. I was there, and I broadly agree with what she laid out there. But I think that there's one point which I'd like to add to what we said, right? Now, yes, there is an impact of a sustained oil hike on the current account deficit and on the GDP, undoubtedly, and on oil-sensitive sectors too. Okay, that's a given. But the reason this correction is happening is not just that. It's about the fact that this has led to an sell India on rise within the FII, especially those with a short-term outlook. And why I'm saying this is, if you see, a lot of the correction has come through the F&O route. It's from the shorting of the Nifty index futures, shorting of the Nifty bank futures, shorting of index heavy stocks on a stock specific futures. So I would say it's more of what would I call it? I would call it is that at this point in time, they're saying just take money off the market. And that's the reason you see the bank index is falling so much. It has very little to do with oil, but it's falling because they're selling. And the selling can be then translated to three different avenues, right? So I still believe that if you look at the gross and net FII numbers, right, about 35 to 40% of the total number, you add the gross and the net together, 35 to 40% of it are actually buyers, 65 to 70% are the sellers. So that's why you have a net delta of selling. Okay. So why I'm saying this is, so it's who is the person then who's selling and who's buying? I still believe that longer term pension funds and all are still buying in the Indian market. And that's why the sell-off could be worse if they stopped buying. So that's number one. So far, the fall that you talk about the Nifty is despite the fact that long-term FIIs are still sticking there and buying, but it's the short-term ones. And the short-term ones are of, again, I'll split that thing into a couple of options there. So there is a short-term of FII, an active manager who takes a call on the market, and clearly for him, the India weightage has to come down because of the oil sensitivity. The same reasons, current account deficit, GDP getting impacted by 25 basis points, and oil-related sectors getting affected, right? That's one aspect. The second is a long-only FII who has to redemption, AIF, let's say, which is bought into India, which has a redemption in the next 3 to 6 months. Now, they don't want to take the risk of that point of time that is returned. So if he's got a redemption in the near future, right, he's selling today. So that's the second aspect. But the third aspect there, which is a very important aspect, is that there are short-term hedging funds which are trying to take advantage of the volatility and shorting it to make a gain. So they believe that they can short and buy back when the market recovers, and they'll make a profit out of it. So these are actually aggressive short sellers. You're getting what I mean? They're not panicking and going away from India. On the contrary, because they know that the sentiment around India with this oil, 85% import, is so negative that they can short it and make money through that short. So these are just active traders playing what they feel is a good profit-making opportunity. And then layering on top of this is that there are passive funds, right? There's the emerging market ETFs, there's the India-specific ETF into which HNIs and institutions and retail investors in the Western geographies put money. Now, they are taking money off the table from the passive fund. So when a passive fund sells, he's got to sell everything. And one of the reasons for the bank index falling is because it's 35% of the MSCI India index. So you can see that there's a range of factors. And why I'm saying this is, in this market, there are still long-term FIs of buyers and there are DIs of buyers. And they have thus far prevented the fall. Now, the point is, are the DIs going to be running out of cash in the near future? That's one thing. I don't think so, because if you take the mutual fund industry and you take the equity component of it is about 35 lakh crore, and you take that, they keep a 5% cash balance, they still have almost 2 lakh crore of cash sitting there supporting the market. But what will they buy? They are smart, right? They are waiting for a correction in something they know has a good future so that they then step in. Of course, they will also avoid the near-term oil-sensitive sectors because they have an NAV on which they need to manage it. So why I'm saying this, there are multiple players at play. So from this point of view, right, as long as the negative sentiment, now if the oil situation gets solved, all of this could turn positive and you could see a sharp short covering rally, people coming in and buying stocks because they see value in it. The only risk here is that India is still not cheap because while our markets have corrected, the cheaper markets have also corrected, like Korea and Taiwan, which have been getting money because they are more, let's say, pro AI and they were at reasonable valuations compared to India. They've also corrected heavily. So, on a relative basis, India still continues to be at about 50 to 55% premium to the emerging market valuations. So, we are still not cheap despite our correction. And the second point is that markets also don't just look at the trailing PE, they look at the 1 year forward PE. Now, on a 1 year forward, people are saying, oh, it's looking cheap. But there's a fallacy there. Why? Because we don't know whether these 1 year forward earnings in this oil hike scenario are going to live up to that earlier projection, which was anywhere between, let's say, 14% for the large cap index and high double digit for the mid cap index, right? So whether that's going to play out, now we don't know. So you can't have a reliable 1 year forward PE to judge the value in the market. So we are sitting in a complicated set of circumstances, but I will also finally end this bit that I'm speaking about with one thing, right? See, this whole thing is for India specific is just this oil related issue. And oil is something which always reacts in either a downward V or an upward V. Why do I point out this V? Is as fast as it fell, it can rise when the war ends or a solution comes to the Hormuz Strait problem. So I'm saying that's a big, low probability but high value event, right? So if, like why I'm saying this, look at this. For the first time, one of the things in oil you'll notice is that the huge difference between the Texas light crude and the Brent crude used to be there. It's gone away. Today, both Texas and Brent are trading at the same levels, which means US oil prices have risen much faster than the Brent crude prices. So this is going to hurt Mr. Trump at his home territory because his own constituency is going to face increasing inflation. His ability to pressurize the new Fed governor to cut interest rates is going to be that much more difficult. And so it's in his own interest to either end the war quickly through increased bombing or whatever, or to maybe as a second part, he's not going to back out, but maybe they come up with a plan B where they try to control the Hormuz Strait part of the war and say, okay, rest of Iran will take care, but let's take control. And that's why they're probably destroying the Navy, they're destroying the airfield so that they can take control, because it's in Mr. Trump's interest also to get oil prices down soon. I know he's already stated that, oh, it's a short-term pain we all have to bear, but it can't become a short-term to a medium-term pain. So my belief is that from an investor perspective, as opposed to a retail trader speculator, right? A retail trader and speculator is in very dicey ground today because the big institutions are at play shorting the market. So for him to take a call on that is very difficult. But as an investor, right, if you look at it, can you not take a call to say in 6 months at the outermost, this war is going to be ended? Because like a Russia-Ukraine war, this is not a war where Europe was supporting Ukraine against Russia and so it stretched on for years. Iran is isolated. Russia is giving some intelligence support. China is giving some support, but it's isolated. So you can't expect an America-Israel axis versus Iran, this war, to be a very long drawn war. At some point of time, the amount of bombing they do, whatever they do, I believe that it will come to an end. And so then you project yourself 6 months down the road. And suddenly you will feel that all of this, because oil can fall as sharply as it rose once the Hormuz Strait thing gets cleared. So then you'll be scrambling to buy those assets, right? When I say 6 months, it could be 3 months or it could be 9 months, right? But all I'm trying to say is if you have a medium-term perspective, then this is the time to continue to accumulate in small numbers to keep averaging your portfolio, right? From a medium-term perspective. And don't worry if what you put in a little bit of money today, tomorrow it gets corrected. You put a little bit more money tomorrow. And for me, it's a rule. It's a simple rule of a 1% of your free cash flow you keep deploying every day in such a volatile, bearish trended market, right? And it lasts for 3 months. Your 1% lasts for 100 days. Let it go through. So I think that's the way I see it. And just to summarize, I believe a large part of the volatility and the correction is due to short-term actions by short-term players. Medium-term players are still there, hanging in there and buying, like domestic mutual funds and foreign pension funds. So a retail investor is best advised to follow these people in terms of his own asset allocation and portfolio strategy. So do not change your asset allocation from what it was just before the war started. Keep it in the same proportion, buy small amounts in the same proportion every day through this crisis.
Got it, got it. Sunil sir, earlier I was reading a report by ICICI where they mentioned that Nifty would warrant another 10% of correction from the current levels if crude oil stays above that $100 per barrel. Would you concur to this statement? Because they're believing that Nifty, once it slips back to 18x PE, that's when it will start bottom and then we can see a rebound from here on.
I broadly agree with that because, and the reason for that is that I know that the way the algorithms are at play, right? A sustained factor of $100 oil into India. And mind you, what's happening is that there's, in addition to the crude, so we mentioned this, there's rupee depreciation. So the landed price of crude is not just $100, it's $100 the new rupee value. So this is a further whammy on India. So I know these algorithmic models for India give a reasonably high weightage to oil prices and to currency. So both of those are currently not in our favor. So I would say that triggering of the short selling, right, could intensify if oil sustains or is an indication that it's going to sustain. And I don't know about the 10% number which you said ICICI is calculated. I'm not sure about the math of it, but definitely if oil sustains, if this $100, see, this was Friday, it was 93. Let's forget that's over the weekend that has gone so fast, right? So,
yes.
so let's see whether the oil situation indicates a sustained $100 stability for a long time. Then yes, there will be even more shots taken by the hedge funds from outside on India.
Okay, got it. All right, Sunil sir, on that note, we have to let you go, but thank you so much for your time and joining us.
Thank you.